Right, okay, without further ado, we are going to look at financial management. So the first session we're going to have is on financial strategy. It's sort of an overview. It sort of gives you an idea of the things that we're going to see when we go through this. And also, I suppose the first day of this subject is sort of different to the rest of it. Unfortunately, there's a lot of me talking in this first day. There are not so many calculations. I don't know if that's maybe good or bad, depending on who you are. Subsequently to this, there's a lot more calculations. So a lot of the stuff we're doing today is a bit discussion based. There's a few calculations, but we do need to have a think about it together, the things that we're talking about. So, financial strategy. What's the difference between this subject and other subjects? Essentially, this subject is forward-looking, whereas other subjects you do in this qualification are backward-looking. For example, tax. When you're doing tax, unless you're doing tax planning, you're trying to work out the tax on the profit you earned when? Last year, okay? So that's looking backwards, isn't it? It's historic. If you're doing a bank reconciliation to prepare a set of accounts, are you doing that on historic information or future information? Historic information. It's looking backwards, isn't it? All the stuff you do, essentially in those sorts of tax, financial reporting, audit, all of that stuff is historic. You're looking at stuff that's already happened. Financial management is not. It's looking at stuff that is going to happen for the most part. The financial manager does three things. They plan investments. So as we go through this, we're going to look at how they do that. We're going to look at investment appraisal. It might be short-term investments, it might be long-term investments. We need to look at each of them. So we'll see how a company might invest its cash, its short-term cash, try and earn a bit of a return. And we'll look how they'll invest for the future to try and earn a long-term return. They also plan financing, because you can't make investments without money. Where do you get money? So when I say financing, what do I mean by that? Where am I going to get that financing? Yeah, investors. And how do investors invest? Shares, okay? Really topical. I mean, I know it's always topical because there's always companies issuing shares and so on, but there are some very interesting companies out there at the minute thinking about listing, and some interesting companies that have recently listed that we're going to talk about. So how do you actually go about getting that money? You maybe issue bonds, or you issue equity, you issue shares. We're going to look at that today. We're going to talk about how you might go about doing that. Or you might just go to the bank, although that's not, for us, we're not really looking at that. Okay, so we got investments, we got financing, we got dividends. So dividend policy is the third bit of this, and sometimes this is referred to as the financial management triangle. So what they do is they think of this as being a triangle that looks like this, and you've got investments, financing, and dividend policy. Now, the reason they do that, and this is the important point for the syllabus, this little bit here is really simplistic. Pretty much you know what an investment is. Pretty much you know what financing is, and you know what dividend policy is. The bit that the examiner wants you to get is the link between these. They want you to get the fact that, well, you can't make investments without financing because you don't have any money. And what about dividends? Are dividends related to investments? What's the relationship there? Well, hopefully, what do you get through your investments? Profit, return. Well, you can't pay a dividend without profit, can you? So you need to have this successful investment before you can pay out this dividend. So that's the link between this. Now, I'd be impressed if you get this one. What's the link between dividends and financing? Because there is one.
higher dividend, the more people's going to want to invest, or no?
Oh, well, yeah, actually, yes. Yeah. So that's not the one I was thinking of, but yeah, I think we'll see in dividend policy that is a reasonable assumption, yeah. Well, let's follow that through. Let's say you do that and you pay out a high dividend, and you now then want to make more investments. What have you not now got? You've not got any money because you paid it out as a dividend, okay? So that's the link here, is that if you pay out high dividends, you then might not have the money in order to make your investments, and you're going to need financing, okay? Are there any successful companies that don't pay a dividend? Would you want to invest in a company that didn't pay a dividend? No, and that's always the assumption. You think, well, they don't pay a dividend, I'm not getting anything out of it. One of the most successful companies in the world, in fact, a few of the most successful companies in the world don't pay dividends. Google don't pay dividends, yet the share price has been exponential. Apple for many, many years didn't pay dividends until such times as they simply had so much cash, they literally didn't know what to do with it. When you've got 200 billion in cash, which is more than the US government, well, they have no cash, but it's more than the US government, you have to pay a dividend because investors start to go, oh, well, we'd like some of that money, please. Why would you accept for many years Apple not paying a dividend if you were an investor? You have a share in the company and share price is going up, but they've got all this cash. Surely you'd be saying, right, okay, Steve Jobs comes along and invents the iPhone. Well, actually, that's a bit questionable. He at least oversees the invention of the iPhone. They start selling by the bucket load, start making all this cash. Why do you as an investor not go, well, Steve, we want some of that cash, please. Can you just pay it out? Just give us the money. What do you want Steve to do with it instead? You want them to invest it. You're like, oh, brilliant. Come up with one of those again. Let's go for the iPad, for example. Not as successful, but still a good product. So you actually, as an investor, might not want the dividend for other reasons as well. But you might be saying to the company, no, don't pay the dividend. I want you to reinvest it in the business and come up with the next big thing and then keep that growth going. So there is a choice to be made when we come to dividend policy. It's not just as clear as saying, oh, well, you made a lot of money, you need to pay it out as a dividend. You've got to think about how you might invest that money into the company and keep that momentum going. So we need to think about that. We need to think about the different policies that you could have. And we're going to look at that towards the end of this session. Okay, so those are the three things. What do you need to know? And I know it's the very first thing I'm telling you, but you need to know this. You need to know the linkage between investments, financing, and dividend policy, how one relates to the other, and you can't have one without the other. Okay, so strategy. Just to point out to you, there are different levels of strategy within the business. There's operational strategy at your functional areas. There's and your finance units. There is business strategy at the sort of mid-level of the business, looking at maybe your competitive position in business units. When we are looking at our subject, we're looking at financial management, we are essentially looking from the corporate level. So we're looking at, should we be going into new markets, current markets? We're thinking from a board level. So I'm just pointing that out at the start. And when we're developing our strategy, we'll have to have consideration of the different stakeholders in the business. Can anyone give me a definition of what a stakeholder is? I mean, is a stakeholder a shareholder? No, doesn't have to be. Would a shareholder be a stakeholder? Yes. So give me an example of another party that is not a shareholder that is a stakeholder.
Employee.
Employee, good. Oh, media. Maybe. maybe, although, so let's think about a definition first. So I would say a stakeholder is someone who has a legitimate interest in the business. Now, the media might have an interest. They might be interested. I'm not sure that they have an interest. Well, you might want to keep them happy, right enough. Okay, look, I've separated them out here. So let's think about the ones that I've got. So I've gone for internal stakeholders. I've gone for employees and managers. Now I've separated these out. This is going to feed into something I'm going to talk about in a second. I'm thinking here about employees as being anyone below sort of board level, the managers of the business. Because these guys, managers of the business, are generally interested in other things. So for example, you guys, I'm going to say at this point you are employees. Yes, most of you, I'm sure. What are you interested in your job? What do you want? Why are you here? You want to get paid. Yeah, you want to get your monthly payment. And what do you not want to happen? You don't want to lose your job. You want to lose your job. You are looking for stability and reasonable compensation. Fair to say? Yeah. Now that's going to change when you get qualified and you become directors and CEOs. It's going to change. What does the average CEO of a FTSE 100 company get paid? What do you reckon? How much? 100,000? Up or down from that? So on some more estimates. So 100,000? More? How much? How much more? 200,000? $250,000? Okay. Yeah, maybe. Anyone think it's any more than that? Couldn't be more than that, could it? The average CEO of a FTSE 100 company gets paid 5.3 million per year. £250,000 is not a lot of money. I know it seems like a lot of money to you guys and me, but that's not a, you go to London, people are getting paid that left, right, and centre. 100,000 is not actually a lot of money. I know it seems like it at this point, but it's not a massive deal when it comes to these companies. I mean, they're making billions. 5.3 million. If you're getting paid 5.3 million, are you so worried about your position? You've made 5.3 million for a few years. Are you going to be out on the streets if you don't get your money next month? And on the other side of that, if you lose your job, what's going to happen? So if they come to you and say, listen, it's not working out. You're not doing a good job here. You're going to have to go. What are you going to get then? You're going to get payout. Bob Diamond, when he left HSBC, made a mess of it. He made several messes. How much did he get when he left? When he left for doing a terrible job? 24 million. 24 million handout. Okay. See, this is why I think this subject is interesting, because you should really, as future accountants, you should really be reading the business pages and really understanding what is going on in the business world. Because this is one really interesting point, this discrepancy in pay between the average worker and the chief executive. I mean, it used to be something like the chief executive got paid 5 times the average worker. It's like 200 or 300 times the average worker. There's no comparison between the two. So look, I'm going to talk about that again in a second. Those are the two internal stakeholders I'm talking about. The external stakeholders, I'm thinking about investors, the community, if you've got an impact on them, the banks, the government, customers, suppliers, all of them are going to have some legitimate interest in the business. They want something from the business. The one that I'm interested in is the one that we've just touched on. So conflicting objectives can happen, and the main theory that you need to be aware of is this agency theory, because this idea of the CEOs and the directors getting paid massive amounts of money feeds into this, because what relationship do the shareholders have to the business? If you're a shareholder in the business, you own it. You're the owner. So let's say you buy some shares in BT tomorrow. So you buy some shares, let's say you invest £10,000. And then next day, you phone up BT and say, listen, I'm now an owner in this business. I've got some strategic decisions I want you to make. So I'd like you to, buy the rights to the cricket for the next Ashes series, please. Are they going to take on your advice? Do what you say? But you're the owner. Surely they should be taking that on board. No? Who runs the business then? The managers, the directors. But they work for who?
Shareholders.
They work for the shareholders. They work for you. Okay, they work for you. What are you interested in? So you invest your 10 grand in BT. What do you want? You want a return? Okay, so I'll pay you a great return. So I'm going to pay you 10% a year. How much do you get on a bank? So let's say you put your 10 grand in the bank. What do you get a year on that? Yeah, maybe 0.7% or something like that, if you're lucky. Put your 10 grand in the bank, you get 0.7%. I'm going to give you 10%. That's an unbelievable return. I'm going to give it to you for 5 years. 10% for 5 years. At the end of the 5 years, though, the business is going to collapse. You'll lose your 10 grand. You happy? But you said you wanted a return. Is there anything more important than the return? What's the most important thing when you make an investment?
Success.
Well, not to lose the investment is the most important thing. Okay? Again, once you get up a bit, once you start making this 250 grand a year, yeah, and you start getting some money and invest in it, it becomes of paramount importance that you do not lose that money. You might want a return on it, but put it like this. Did you know that the interest rate in Japan, and actually I think the ECB as well, what's the interest rate in the ECB? Yeah, it's minus 0.5%. So I'm a bank, and I'm saying to you, you put your money in the bank with me, and I'll charge you 0.5% to do it. Why would anyone do that? Why would anyone put their money in the bank if they know they're going to lose money on it? But what did I say was the number one thing you want to make sure when you make an investment? You don't lose your money. Fear. Fear is why you put it in there, because you're worried. I mean, it's a bit of it's strange times, let's say, out there. I mean, you could put your money into something and you could lose it with Brexit and all this stuff happening. So you're putting it in the bank, you're accepting that you're going to make less of a return because you do not want to lose your capital. Let's compare those. You're a shareholder. You're invested in the business. You do not want to lose your capital at all costs. Who are you relying on to look after that capital for you? Yeah, management CEO. What does the CEO get paid? What did we say? How much? Average? 5.3 million. What was the highest salary of a CEO in the FTSE 100 last year? For 1 year? 74 million annual salary. Yeah? Are they particularly interested in the long-term stability of your business that you own? No. What do they want? Want more money. Want a bigger salary, want bonuses, they want to buy a yacht, a 5th yacht, they want to buy a 20th house, they've got 3 wives to look after. Come on, these guys need money. Okay, so what do? How do you get money? So you've got management. If I'm trying to run a business and I need to make money, what do I take a lot of? How do you make more money? Take more risk. You take more risk. If you want to make a big return, you take more risk. That's a really important concept that we're going to keep coming back to as we do this stuff. You take more risk, you make more money. These guys take more risk. What potentially happens to your investment? you lose it. This is what happened in the banks, 2007. What the management were doing was they were trying to take more risk. They were taking on all of these collateral debt obligations, etc., which we'll talk about as we go through this course. They took a lot of risk because they wanted to make a lot of return, and the banks went bust. And that means the shareholders are left with nothing, okay? But the managers, what are they left with? Might have lost their job, but they've been making 10 million quid a year for 5 years. What do they care? Okay. And again, I see Bob Diamond Bob Diamond came back to buy a division, the African division of HSBC that he'd messed up in the first place. So he went and got other investors and bought over the bit that he'd messed up because it was so cheap because he'd messed it up. Unbelievable. Okay. So this is the sort of thing that's going on. I think, again, this is one of the most interesting subjects because you will see all of this stuff we're talking about actually happening in real life every single day. Looking at the FT, look on the BBC business pages, you'll see dividend policy, you'll see problems between management and shareholders. So you've got to try to get goal congruence. You've got to try to make sure that your shareholders and your managers want the same thing, because they don't, and that's the agency problem. The reason it's called the agency problem is that the shareholders are what's called the principal. The managers are what's called the agents because they're acting on behalf of the shareholders. And the agency problem is that the agents don't necessarily do what the principal want them to do. So managers don't necessarily do what the shareholders want them to do. Can you think of any ways you could get goal congruence? So we want these two parties to want the same thing. How could we make sure that they want the same thing? Yeah, we could pay them in shares. The only problem you've got is if you pay them in shares immediately, what could they then do? So if I thought, right, I took a lot of risk here, but the share price is going up and they're going to pay me in these shares. In fact, Michael O'Leary, did you see Michael O'Leary's pay package yesterday? Well, now actually, Michael O'Leary, it's an interesting one because Michael O'Leary, as the head of Ryanair, gets paid something like $500,000 a year. So that's his salary, base salary. But they were voting in the shareholders meeting on his pay package, and his pay package includes a clause whereby if he doubles either the share price or the profit in the next 5 years or something like that, he will get paid £91 million in shares. Okay. Now, a lot of them voted against it, but I can sort of think that that is half reasonable. I mean, if he's going to double your share price or double your profit, Ryanair makes $1 billion a year. He's going to double that to $2 billion. He's going to double your share price. Like if someone said, see that 10,000 investment, I'm going to double it in the next 5 years. Would you be interested? Yeah, so I can see, okay, 91 million, maybe a little bit excessive, but you can see some justification in that. And he does have a very low initial salary, 500,000 a year, 91 million if you do certain things. That's an element of goal congruence. You want your investment to do well, so does he. So that might do it. The problem would be that if you give it straight away, so if you just give shares, they can just sell them. So what you tend to do is do what they've said there is after a number of years, we'll give you them. Oh, but if you hit certain targets. Okay, so it's trying to get that idea of goal congruence. And you need accountability. So management need to be accountable to the shareholders. Okay. Look, that's the agency problem. It comes up a lot. You'll see it throughout the syllabus. So it's always this idea of management not doing things that are in the interests of the shareholders. Look, you've also got the idea of the profit versus the community. So just this impact on the local community that can come from, for example, moving all your operations to China or something like that purely to seek more profit. That would be an example of conflicting objectives as well between stakeholders. Right, okay. Be aware of what stakeholders are. Be aware that their objectives are not always the same, and be able to explain the agency problem. That's the key things in there. Right, okay, let's start looking at some finance stuff. So, every business is going to have financial objectives. The number one financial objective is to maximize shareholder wealth. Now, this is a bit contentious because this does not necessarily ring with the whole community, with the environment, with everything else. What this is essentially saying is that the only thing that a business needs to do is make money to maximize shareholder wealth. So if you're an environmentalist, you might say, well, look, actually, you need to think about your impact on the environment, or you might need to think about your impact on the community. Or here's an interesting example, Starbucks. Anyone ever had a Starbucks? Yeah, you're aware of this, like coffee shops, like on every single corner in the world. Did you know that Starbucks in the UK don't make any money? Yeah, did you know that? They just do it for the fun. How do I know they don't make any money? They don't pay any tax. They don't pay any tax. They actually said, no, we don't make any money in the UK. Do Starbucks make any money in the UK? Of course they do. Why do you keep opening shops everywhere then? Of course they make money in the UK. So, as a member of the UK population, well, yeah, no, we're still UK. Maybe not European yet, or well, let's see. We're still UK. As a member of the UK population, do you want Starbucks to pay tax? Yeah, of course we do. Of course we do. So, let's say you take your 10 grand and you take it out of BT and you put it into Starbucks. Do you now want Starbucks to pay tax? Maybe a little bit. Maybe give them a tenner. Yeah? But it's a different thought process because you're now going to be directly influenced by that. So by this rationale, by the maximization of shareholder wealth, actually, if that was your financial objective, it would be perfectly rational for the managers in Starbucks to go, well, let's minimize to the best extent our tax. And if they come in and go, well, actually, we don't have to pay any tax this year. Like, happy days. Brilliant. That's brilliant for shareholders. We can pay a bigger dividend. Okay? So there's a little bit of nuance there, but this is going to be our first financial objective. The way to calculate it is the share price growth and the dividend, because if you invest your 10 grand and the share price goes up, maybe it's worth 11, but you're also going to get paid a dividend. So if you get paid 500 quid in dividends, that's 1150 that your investment is now worth. So that's the maximization of shareholder wealth. And if you were thinking, well, how much has my shareholder wealth gone up by? It's the difference between the 10 grand and the 11 and a half that you now have. Okay? This comes up a lot. I know it's the first calculation that we've looked at, but it's one of those ones that comes up all the time. So let's look at illustration 1 in the